Hello, everyone. I think we're live. Okay, welcome, everyone. I'm going to go through just a few things here to kick us off, and we'll have some people signing on, I'm sure, over the first few minutes here. But the first thing that I want to highlight is you have some chat functionality. And we want everyone to use the chat. So make sure as you're chatting, setting there that allows you to chat to just the panelists or to all attendees. Go ahead and switch that to all attendees. Let's get some community chat going as if we were all in the same room. A little networking. And to start it off, as you chat, just put your name in there, your company name, and if you have a quick one-liner about what your company does, just introduce yourself to everyone. And so we'll wait a few more minutes before we get started. I know everyone is stressed and time challenged. Hopefully we've got you, if you're on the West Coast, during your lunch. If you're on the East Coast, it's tea time and a good time for a little break. We've been doing these roundtables over the course of the last few weeks. And I think it'll be a very, very informative session. So again, as you're joining us, feel free to chat and introduce yourself to the rest of the folks here. Name, company, where you're joining us from, if you want to put that in there in a quick one-liner. What I'm going to do to start us off here is just some quick introductions, and then the roundtable will get kicked off in about 2 or 3 minutes. So let's see if I can get us going here on. Okay, perfect, that's working. All right, so introduce myself. My name is Dato. I'm the CMO at Early Growth. I've been with the firm for about a year, but my background is as a serial entrepreneur. I got to know Early Growth when I started my last business 10 years ago. I hired Early Growth to be my CFO. My background was in finance. I was a CPA for 10 years. I was a CFO at previous companies. But I knew that as I was starting a business, I had other things that I needed to focus on. So 10 years ago, I got to know Early Growth as I hired them to be my CFO. I'm coming to you live from Early Growth HQ here via a Zoom virtual background. Obviously, we're all holed up at home, but I'm based in Santa Monica, California, and the Los Angeles area, but originate from the East Coast, and I've lived all around the world. So that's a little bit about me. The webinar today, we'll have a discussion that will go pretty much an hour long. And although we'll start talking about some things, I encourage you right off the bat to start asking questions. So you have Q&A functionality in the webinar. Anytime, start adding questions to the Q&A. And again, feel free to use the chat. Make sure you're chatting with all the panelists and all the audience. And so if you want to get started in there, just drop your name, maybe where you're from, company name, and a one-liner about your company. The webinar will be recorded, so it'll be available online, and afterwards we'll send out links for you. So you don't need to worry about keeping notes. You'll be able to come back and reference the webinar. Let's go forward. Just a little bit about who Early Growth is. We're an outsourced CFO firm. And as I was saying, as I hired Early Growth 10 years ago, we're a strategic partner for early stage companies, high growth companies, venture-backed companies. And we act as that strategic partner to help you handle everything finance, from the day-to-day, month-to-month blocking and tackling to the bigger strategic issues of how you fund your business, how you lay out a financial plan, build financial models and budgets, so that you get the biggest bang for your buck. But it also allows you to focus on your business at hand, your product, your service, your customers, your own team. A little bit about what we do. As I say, we cover the entire finance and accounting stack, from the day-to-day and month-to-month to taxes, to helping you manage your cap tables and your equity. We also serve as the CFOs of a number of investment firms, seed stage and smaller VC firms, but we've been representing folks in Silicon Valley and coast to coast, both on both sides of the startup table, from entrepreneurs to investors. As I mentioned, I hired Early Growth close to 10 years ago. The firm's been around 11 years. The CFOs who will be part of the roundtable today are really a perfect profile of our CFOs. These are folks that have been in the business world for longer than they want to admit, but our average CFO experience, 28 years, and they're involved in fundraising over and over and over again. So you'll recognize some of the names. We've been around, and we are the biggest provider of finance and accounting services to early stage companies. These are our panelists today. I'm going to get rid of the slides so that you can see them, but I'm going to ask each of them to just give a quick 1-minute introduction so that you know who you're hearing from today. So, Steve, why don't we kick off with you?
Hi, everybody. I'm Steve Olson. I've been with Early Growth since about 2012, and prior to that, I had my own practice for about 4 years. And before that, I was at several different technology companies and services companies with venture backing for, I'm not going to say how many years, but a long time. So yeah, glad to be here.
Awesome. Thanks, Steve. Alaa, why don't you go next?
Hello, everybody. My name is Alaa Ismail. I've been with Early Growth for almost since the beginning. Prior to that, I started out my career in public accounting and moved on to various roles, primarily in software and hardware type companies here in Silicon Valley, and worked with a lot of interesting companies over the years, and I'm happy to be here.
Awesome, thank you. Carl?
Hey guys, Carl Pollock here, Early Growth as well. Been with the company a little over a year. Before that, I was in private practice for about 7 years, and I've been in finance and strategy in a number of different industries, including tech, healthcare, med devices for a little over 20 years. So I know I don't look that old, but you know, happens.
That's the California sunshine, Carl.
That's it.
So, and Rhonda, why don't you finish up? You're on mute.
Hi, everybody. I'm Rhonda. I have been with the Early Growth also for a little over a year, but I've been doing contract CFO work for about 10 years. I have been a full-time seated CFO as well as an investment banker, and I'm a CPA. Industry expertise in healthcare, biotech, pharma, medical device, as well as e-commerce, financial services, and asset management. Do a little bit of tech, but mostly the other industries. And I think in terms of being a seated CFO, I think that would be, I'd say, the earlier part of my career. And I like the variety of working with different companies that Early Growth offers.
Great. Thank you to all of you for joining us today. I know when we started putting together these roundtables, we were thinking maybe a little bit more generally around some of the issues that startups are facing when they go through an economic crisis, cash management, financial planning. But I know that the hot topic for most people are the government relief programs that are available right now. And so there's a few different programs that are out there. So Rhonda, what I'm going to do is I'm going to ask each of you to maybe just give a quick overview for the people participating of each of the programs. And so Rhonda, I'm going to ask you to explain a little bit about the EIDL loan.
Actually, I'm going to ask you to switch since I haven't. I'll pass that one on to one of my colleagues. I've been doing the PPP loans for the last couple of days and not the EIDL, if that's okay.
Okay, yeah, and I want to
Do you
handle
mind if
that
I
one
switch
last.
that over to someone who's got expertise in having filed that?
Absolutely, absolutely. So most of the audience knows we've got about 50 CFOs who are all becoming knowledgeable about different aspects, but working as a group. So we've got this collective knowledge. Who wants to handle the EIDL loans?
Hey, I'll help you out, Dan, if that's all right. So just like any government program, the EIDL is it's a fantastic, I would say, mechanism, but there are definitely some hangups to watch out for. I think the word on the street now is the EIDL is a simple document and a simple setup to go through and apply for. And while at times that looks right, there are a lot of complexities in it. And so the EIDL, for those who don't know, it's a loan program that the government set up initially to help small businesses go through and kind of ride out this economic wave that we're having right now. And the way it's going to do that is in form of a small business administrative emergency loan. So essentially, I think now pretty much the entire country has been declared a national disaster area. And so it's a way historically it's been used in many things out here in the West. I think we're going to know about the forest fires in New York City, you know about the hurricane that hit you guys not too long ago. And so whenever those things happen, the government sets up these loaning facilities that make funding available to different companies. And this one's really targeted to all companies, but specifically to those that had some revenue. And so the idea there is you do need some financials, put some financials together to go through and declare how much the potential loan could be. You also need to have your ownership interest available and understand the ownership, not only the ownership interest, but also some of the implications along with that ownership, including the affiliation rules that are coming down the loan. And so I've been helping clients a lot over the last few weeks. I'd like to say months. It feels like months, but it's only been weeks of going through and digging out that information and then distilling that into those forms that are necessary to get the process going. Now, in the background, what we're also doing is we're also preparing for that later stage interview and also forms that the government is also going to want in terms of understanding the liabilities that are currently available, or currently out there, as well as potential collateral and funds that are available to the company currently, so they can really assess the need, but more so, do you have the availability to pay it back? There are some nuances, and I know I'm speaking a lot, so I'm going to kind of cut off there, but there's some different nuances about the amounts and the implications of those amounts. And the nice thing about the EIDL is that you can apply for that EIDL regardless or not if you're applying for the PPP, which we're going to get into here in a few minutes.
Awesome, thanks, Carl. That's a good overview. And I know there's a lot of details. We'll come back to this subject. Okay, the next one I wanted to talk about, and I'm not sure if any of you have the firsthand experience with it, but it's the Employee Retention Tax Credit Program that's available through the IRS. Alaa, I see you nodding your head. Do you want to take that one?
Sure, and I'd love to have the other CFOs chime in if I get something incredibly wrong. The simple reason for that is that the tax credit program is really something that a lot of our clients really haven't gone full dive into it. Essentially, what the program allows you to do is to get a credit on a significant portion of your quarterly tax payroll tax obligation. That will be filed along on a quarterly basis, probably with your payroll tax provider. And to the extent that you have the amount of the retention tax credit that you qualify for, that will be a direct reduction of your payroll tax liability. To the extent that the credit exceeds your current liability, you will be able to get a credit to carry forward. And to the extent, of course, that it's under, you will only have to pay the difference. The advantage here is clearly to larger companies that have a a fairly significant quarterly payroll tax or have a higher employee base. A lot of our clients, just because of the lower amounts that in their payroll, so the amounts may not be as significant as say some of these other programs, but it is there. And to the extent that that you would like to go and qualify for that, you know, it's an option to improve your cash flow and to get you a little bit of benefit. Again, you know, the other two programs will supply you a lot more liquidity, but to the extent that you have a large enough payroll that the the ERTC would help benefit you, it's an excellent program to participate in.
Awesome, thank you. So one of the key aspects of that program that I understand is if you're utilizing that credit, you couldn't utilize the PPP loan and vice versa. So as Rhonda, as you described the PPP loan, one of the things for people to understand is it's either or, and part of the analysis here is which one is going to be of more benefit to your business. That employee retention tax credit will offer you benefit over a longer period of time. So if you don't need the cash today, it's quite possible that that program may end up being more beneficial to your business. But Rhonda, why don't I kick it to you, since you wanted to talk about the PPP loan, and this has been hot thing in the press. It's on every news channel. It's all over the social media, whether it's working or not working and the problems that are there. But why don't we go up to 30,000 feet, Rhonda, and just give a little highlight of the program.
So since Friday, I've been working 24/7 on PPP loans. The Paycheck Protection Program has been designed to provide cash to small businesses who need assistance in keeping their employees paid over the next several months. So the program is basically offering you what is comparable to 2.5 times your average monthly payroll, using typically 2019 and to calculate your average monthly payroll. But the government is offering 2.5 times that in return for the fact that you will retain your existing employees at their current level of pay. So essentially, it was set up to take the pressure off the unemployment programs state by state, but also with the hope that we would all return back to work full time after 8 weeks, that this would be a bridge to keep people employed with income coming in. And the program itself is being handled by approved SBA lenders. So you do need to apply to a bank, in contrast to the other loans where the EIDL, for example, you apply to the SBA. With a PPP loan, you apply to a bank, ideally one where you have an existing account. And then the bank will serve as the conduit with the SBA. They'll issue the loan to your firm, and they will get either repaid by you, or if the loan is forgiven, and give me a second on that, if the loan is forgiven, they'll get reimbursed by the SBA. So the last question is, how can I get a loan but have it forgiven? If you prove to your lender that in the 8 weeks subsequent to the day you receive the funds, that you have used 100% or whatever portion you used for payroll, rent, utilities, benefits, then you can get that portion of the loan forgiven. And for many people, they can 2.5 times their average monthly payroll will cover all of their payroll expenses, including benefits, as well as rent and utilities.
Awesome. Okay, so some questions are starting to roll in here, and I'm going to open it up, but I want to make sure that we're touching on the aspect program that I know that that our attendees are having some questions about. So the first one is about employee classifications for these programs and who qualifies for what loans, whether we've got limits and doesn't include contractors or not. I know there's a lot of discussion that's been going on that. So as a general topic, I'm going to throw that out there. I know we've been learning more and more as every day goes on, but maybe you can provide a little guidance. And Steve, we haven't heard from you, so I'm going to kick it down to you if you want to tackle this first.
Sure.
But maybe sharing a little insight about employee levels.
Yeah. So for companies that are applying for this PPP loan, you can't include contractor expense in the calculation. It's strictly employees. And the reason for that is because independent contractors will have the ability to apply for this loan themselves and get that same benefit essentially. So if their clients were applying on their behalf, there's kind of a double dipping potential there. So the answer to that is no. And that was not very clear up front when this program was first approved in the CARES Act. Since then, it's been clarified and it's clear, no contractors in that calculation. With respect to the calculation, it's been a little bit fuzzy, and different lenders or banks are asking for different information. And I honestly think it's still a little bit fuzzy. And what it's going to come down to is just being able to provide a calculation that's rational, that makes sense. We've heard lenders using the last calendar year as the basis. We've heard an option to use the last consecutive 12 months, starting from when you apply, which in this case would effectively be from March 31st, which was probably your last payroll. Then there's some other issues. I have clients who didn't start payroll until this year. And if you do a 12-year look back for them, their calculation just tanks because they use an average over 12 months. And so their actual benefit doesn't even come near covering their current payroll. So I think these are challenges that are going to have to be worked out. And and I'm hoping that it'll be a rational response to that. Other situations that we run into is clients who 12 months ago had very little payroll and they added employees, in the last 3 or 4 months, and now they have a pretty significant payroll level. And they have the same issue with, if you average over the past 12 months, it really undershoots what their real payroll is. And in addition to that, you've got people that have terminated potentially, in the first 12 months, or going back to the initial look back period. And that tends, depending on the way you calculate it, that tends to deflate your potential also. So needless to say, there are payroll providers out there like Gusto, who actually have created a reporting package specific for this that you can use, but it also potentially, it doesn't address this issue of, less payroll 12 months ago, more payroll today. So in some cases for my clients, I'm doing a custom calculation, and we're going to take the position to submit with that. That's a truer picture of where they're at. And then, if there's pushback from the SBA or the lender, we'll have to address that. But because it's a more rational picture of where they're at, right, and the benefit that they should in theory be able to have in order to keep their workforce employed.
Does anyone else want to chime in on that?
Dan, could I just address that exact point that Steve just mentioned about the custom calculation? In the 3 PPP applications that I've been involved in, the banks have just simply been asking for information. They haven't been doing any clear underwriting, methodology. They're not auditing your reports. They're not looking at your payroll tax report details. They're just requiring documents. My guess is that the next step will have some kind of underwriting criteria where things like seasonal employees, payroll calculation over the 12 months, all those things will become more clear. So I am kind of taking the guidance, as long as your calculation methodology is sound and based on reality, you're not just making numbers up. Then I think that's where I'm starting. So for example, some companies are using the 2019 12-month look back for the whole entire calendar year. Some companies are going back just the previous 12 months to calculate. I'm taking the position as I'm going to take the most advantageous look for my clients. I have clients who have ramped up hiring in the first quarter of 2020. So obviously looking back in the preceding 12 months is more advantageous. Just one final point is that this is also something that each company should evaluate, because regardless of how you look at the payroll dollars and even the forgiveness clause, it may be to your benefit to look at an EIDL loan to get you a lot more liquidity. Granted, there's no forgiveness clause there, but you might be able to get a lot more liquidity.
One of the questions that's come up in the chat related to this issue, as well as seasonal businesses that might have very natural variations in their employee levels, which can throw things off. Is that something else that we're seeing? Carl, you wanna?
Sure. I mean, to add on Alaa's point here, I think what I'm seeing across the spectrum of banks is a lot of it's going to come down to the lender. And also what I've been seeing is a lot of the data being requested or data provision is going to be on the own of the business itself. And so the government in this case, I think they're giving a lot more, not necessarily leeway, but they're putting a lot more responsibility on the business than the bank in many cases. And so I think, as long as what you're doing makes sense and is rational, you're going to have to talk to the banker about it and make sure it passes their sniff test. But I think in general, there's going to be a lot of different ways of coming to a conclusion of a basis for the loan. And to some other points about new businesses, you got to go with the best data you have, and not everyone's going to have 12 months of data. I've heard of folks going through and submitting using their January payroll. As long as it's not artificially spiked and things, I think you're going to be okay. But once again, it's going to come down to making sure you have good documentation to support the basis you're going for. That's going to be able to get the support from your banker to put that number in the system.
Yeah, I've been seeing things change very quickly. I thought I recalled seeing something that gave the option of companies using just the last 2 months payroll. So if they were, like in Alaa's case, if they were a high growth company and they had ramped up payroll, the program was designed for, hey, we want you to keep all those employees. We know that you might have gone from 5 to 50 employees. We don't want you to average it and end up with just enough money to pay 25 of them. We're willing to give you money for where you stand today. Is that correct? Is there a provision in there to just look at the recent, if I can't remember whether it was 2 or 3 months?
I have not seen it, Dan. But again, every bank's requirements and document requests are a little bit different. But I haven't yet seen that one I haven't yet seen that as an option. So just to reiterate what others are saying, but give you a little bit more specifics on the seasonal, while they were talking, I just looked up and verified. So if you claim you're seasonal, you have seasonal employees, or that's the nature of your business, the guidance is to use a 12-week payroll period, February 15th, 2019 through June 30th, 2019. So now I had a nonprofit that I work with that called me today and say, but I looked at that and that would give me a lower average than if I used the 12 months. And so I suggested that they stay with the 12 months, because even though they only put shows on twice a year, if you average it out for the whole year, the seasonality isn't as important. And to support what all my colleagues have said, use the alternative that gives you the best end result, because either way you can support it with payroll documentation. So that's the guidance I would give. Most of my clients are not even using the seasonal option. They have used the full-time option and used a 2019 payroll report or a 12 months ended February 29th.
So
The other thing I was going to add as I was looking at the chat room, just a question to answer the question for the individual who asked about, well, what if I'm an LLC? That's a problem. So let me speak firsthand to tell you that you are eligible, and ideally your supporting documents should be your 1099s, because you're an LLC, you're not a W-2 employee, and you don't have employees whose paychecks you need to support. However, the banks haven't quite caught up to this from what I understand, and I can tell you for sure one of them that I actually entered data into for an independent contractor was not prepared. They keep asking for the same documents that they ask for from corporations. So if they ask you for a 941, which is something that you would prepare if you had W-2 employees, but you are a C Corp, not a Schedule C organization, then I would just resubmit your 1099s and then wait for the bank to call you.
Yeah, that's Dan, can I chime in here too? That's actually a great point. There's a couple of, and we apologize if we're being kind of fuzzy, because there's a lot of fuzziness involved. For example, whether you could include independent contractors or not, the last SBA loan guidance kind of contradicted itself within three lines, where in one paragraph, they said that to include independent contractors, and then in literally 3 lines after that, they say do not include independent contractors, as independent contractors could file for a PPP loan. However, when you do file for the PPP loan, as Rhonda mentioned, the banks are just not, they don't understand that independent contractors don't have 941 tax returns, payroll tax returns, because probably they're getting 1099s in most cases. So the link from the required documentation from the banks and what the provisions of the loan say are just inconsistent. And the issue is that the banks are so overwhelmed that it's hard to contact the bank and ask questions and say, okay, here's my situation, what do I do? And there's this mad scramble right now just to get applications in. So the guidance to my one LLC company is just to put in the amounts and to try to get the application in with whatever documentation you could use, knowing that there's probably going to be a next step. And hopefully in that next step, you could more clearly identify your business and figure out what the loan is. And that next step is probably going to be prior to the actual loan funding. Is my guess. I don't know what others think.
yeah, so there's 2 things that were mentioned that maybe I want to unpack. Rhonda, you mentioned you were working on this for a nonprofit.
Yes.
So we've had questions about C Corps and LLCs, but you also mentioned a nonprofit. So there's a lot of people who are eligible for this that might not be knowing that they're eligible.
So clearly independent contractors are eligible, as are nonprofits. So just to clarify, this is work that I do pro bono because I'm on the board of a theater company in New York. If it ever comes back, that is, theater in New York. So they, as their quote, only financial board member amongst a group of very artistic people, have been calling me nonstop for assistance. They are absolutely eligible, and the same documents that are being requested by a corporation are being requested from the nonprofit, and they're available. They've got payroll, they've got payroll reports. If they are using a firm like ADP, they have the tax forms available to them on their, on their payroll system links. If they use a PEO like Gusto has a report that they've been working on over the weekend. It's now available for download. JustWorks also has a report. So, again, yes, they are absolutely eligible. Be ready if you are a nonprofit and on this call, just have available for uploading the same information that you would have if you were a corporation. So just again, that's your payroll support, the documentation on the 12 months and the monthly average. When they get to the questions of, do you have a 20% investor in this company? The answer is no, or not applicable. Each bank has a different system that they have built. And so you're going to have to play around with what you see in front of you and answer the questions as best you can, in the hopes that you'll still be able to move on to the next step if you answer no or not applicable. And it's not your fault. Trust us when we tell you the banks have not really caught up to speed with this program, and there are a lot of flaws in the various different systems, and so we're just trying to work through it.
So the second thing I wanted to unpack, and maybe I'll ask someone else to talk about this as well, is this PPP loan is administered by a lender that the SBA has approved, and the loan is guaranteed by the SBA. And so you keep mentioning, all of you, hey, it depends on the lender and they're doing things different. Maybe it's worth just sharing some of those differences that you're seeing and how each bank is approaching this. Can you just walk into a bank that you don't have an account for and apply for a PPP through them? Maybe share a little of the experience of what the banks are saying right now. I'll just throw that out.
We've had some real interesting issues with some of the banks. Wells Fargo kind of pulled a Charlie Brown on us and pulled the football out. I had several clients with Wells Fargo accounts that are now going through and working with their funding partners, whether those are angel or not, to work with their partner banks to try to get some apps in. Chase seemed to have had a good system queued up. I actually know a few bankers at Chase, and they're extremely busy calling people back to get that processed. But if you don't have an account with Chase, then you're out of the mix. Chase won't take you. B of A has been extremely stringent on their requirements as well, saying not only do you have to be a business account, but you also have to have a lending relationship with them, i.e. you've done some lending banking with them in the past. It's one of the popular banks out west here is Silicon Valley Bank, and they were a little bit slow on the draw as they hadn't historically worked with SBA loans, but they're actually kind of coming up and going here. What I've been hearing a lot of, and what I've been seeing actually from a firsthand basis, is community banks, local banks that work with the SBA historically are having great success in not only processing your loans, but also working with folks to explain the process and what they need. Now, once again, it's not always consistent, but if you have the availability to work with a regional or a local that does have an SBA accreditation, I implore you to contact them before you contact one of the big guys, because they're gonna work with you a lot more, and they seem to be processing things a lot faster. That being said, I out of those, I don't know how many are going to be taking newcomers. I got an email from a client last night, saying, "Hey, found this bank out on the Eastern Seaboard. They're going to take my business, and so now we have a conference call with South Carolina." So it's there are opportunities out there. You just have to find them, and if you have accounts with some of the biggers already, then you're probably in a lot better shape than most.
And just to add to that, your first choice should always be the bank that you have a relationship with.
Absolutely.
Go to them first, because they will prioritize you if they're participating in the program.
Yeah.
Yes, there's also a process in banking called the Know Your Client process, or KYC. And if you're going to engage with a brand new bank, you're going to have to go through that process with them. And that's going to add time to this whole thing. So, and different banks have different length of times they go through when they're verifying who you are and are you legitimate, and your ID and blah blah blah. So that's a consideration if you're going to engage with a new bank other than your existing bank.
But I will also add, though, if your bank gets back to you and says we're not participating, or we're tapped out, the program's closed on our end, we found out that Veeam is actually taking applications. So if you use Veeam at your business and you have an account with Veeam,
but they're using a relationship with a different lender, I think, right?
Correct, but they are serving as a conduit.
Yeah, and it looks like QuickBooks is going to do something similar.
Yeah, and I believe PayPal also is talking about participating in the program as well. There's a question in the chat about, and the question is, can you do both of them? And so I know you touched upon that earlier, but maybe it's worth talking about how those two programs might work together.
Yeah, our guidance at this point is you can do both. In fact, in some of the applications on PPP, they're actually specifically asking if you've applied for the EIDL. I'm not sure how they're going to use that information specifically, but our guidance at this point, and again, there's a lot of moving pieces, is that you can do both, but ultimately, if you get approved for both, you have to allocate use of funds very specifically and be able to account for that very specifically. So, your PPP, you'd want to use those funds for payroll related stuff almost exclusively. And that could entail, just to ensure you don't mix funds and get confusion around what you're using the proceeds for. You might be advised to create a new bank account where those funds go and have your payroll firm draw specifically out of that account until they're gone. That's one way to keep it segregated. But yeah, this whole segregation of use of proceeds, you can't, as I understand it right now, and maybe one of my other colleagues can clarify, but as I understand it, if for instance, if you use proceeds from an EIDL to pay payroll, that could jeopardize potentially your payroll, your PPP loan forgiveness elements. So there's those considerations, but I think in general, you should be able to use both or apply for both.
As the PPP outlines, they want those funds to be used for payroll.
Right.
And as long as you use 75% of those funds for payroll within the first 8 weeks of receiving your funds, a lot of that's going to be forgivable, or I'm going to say eligible for forgiveness, because who knows what comes through the process, but those are going to be eligible for forgiveness versus the EIDL, which is that's a longer term loan. It's a different facility. Both are great facilities. Who doesn't want 30-year terms at under 4% for a business on half a year's revenue, right? But yeah, you definitely want to make sure you're using those PPP funds for payroll as much as possible.
If I can just add to that, just keep in mind that, let's say you can't use 75% for payroll, and so not all of your loan is forgiven. Let's say your employees decide to leave on their own, or relocate and move away to another, out to the the boonies, because they don't want to, they're afraid of being in a city. The loan interest rate is only 1%, and it's a 2-year loan. So you can make a decision after 8 weeks and look at how much is forgiven and look at how much remains outstanding as a loan, and decide, do I want to pay it all back right now? Or do I want to hold on to the money and pay 1% interest for the next 2 years? And so I think it's worth pursuing because you've got some time to make that decision.
Yeah, I think that goes into the whole idea of trying to get as much as you can, right? Because nowhere else you're going to get 1% business loan.
Right.
So we've got about 15 minutes left. One thing I wanted to mention is there's some questions that have popped up about how can early growth help. And so unlike the banks who are not taking on new clients for PPP loan applications, we are taking on new clients to help with these issues. They're complicated. You need the money now. You need to make right decisions, and these CFOs can help you. So if you go to earlygrowth.com, you'll see a link right at the top of our site for COVID-19 financial aid assistance help. And we've put together a very, very simple service. So if you need advice, you need help doing these calculations and deciding which program is for you, we can help because as you're seeing from this discussion, depending on the bank and depending on your individual business circumstances, the answers may be very, very different for each of you. So as much as we try to give some general advice here, we really, whether it's early growth or another trusted advisor, really encourage you to get a trusted advisor on board so that you're able to maximize the aid that's available to you. We have a question that's not related to this financial aid, that's more related to just managing your business through a financial crisis. So in our last 15 minutes, I want to turn the conversation in that direction. Jim Hall asks, how important is performing a customer account review regularly, especially now, to determine credit risk of the customer base? So I'm going to throw that out there, and maybe we can riff here just into some other general fundamentals when it's not just your business that's being stressed, but it's the business of all your constituents, from your customers to your landlord to your investors, and how you might address that in terms of adjusting your own financial procedures and operational procedures.
Yeah, so
Go ahead, Carl.
yeah, I'll jump in here. So yeah, I think you definitely want to be in close contact with all your clients and customers. And if you have a client that's out there who, you know, is a credit risk, you probably want to talk to them immediately and offer them terms. And it might not be right in all cases, but you know, 75 or 80% of the dollar is better than 0% of the dollar. And if it's, you know, between paying you off at better terms and paying someone else off who's not giving them terms at all, they're more than likely to pay you. And so the idea is get on the phone, have those conversations. Now that's on the, of course, your client-facing side, right? And there's the other side of the P&L too, which is your expense side. I implore you to get on the phone with the folks that you're paying on a regular basis, whether it's your landlord or other service providers, and start talking about, hey, we're going to get hit from this thing. We want to stay in good communication with you. We love your services, but you know, what can we do together to maybe extend terms or reduce the amount of principal that's owed? So yeah, absolutely make those calls. Right now, I think cash is going to be king. And I think cash is going to be king for a while. When you start looking at the overall macroeconomic forces, I think we're looking at a situation where, you know, we're in a world where deflationary forces are going to be more so the average of inflationary price or inflationary forces. And you're going to really want to preserve as much cash as you can and get as much cash as you can into the coffers, not only to preserve the life of your company and your runway, but also to really take advantage of the situation where all possible to explore opportunities that before were not in your wheelhouse or not affordable. I know I'm a little long there, Dan, so I'm going to go ahead and turn it over to someone else as well.
Yeah.
I was just gonna,
So, oh, I'm sorry, Rhonda.
well, I was just going to add real quickly that you could also consider a deferral of payment with your clients as opposed to a reduction.
Right.
All yours.
I'd like to kind of take a different path to this. I think this is a excellent time. One of the things we advise in almost every single one of our webinars to startup companies, regardless of the situation, is a forecasting process that's updated on a regular basis. I think right now is the best time in the world to look at not just customer issues and P&L issues, but your business as a whole. I think this is incredibly an unknown situation, but my read is, and everybody on this team's read is that, and our founder this morning kind of reiterated that this is probably going to last for a long time, that this is probably going to be different than anything that we've encountered before. So this is a good time to kind of look at your business as a whole, and try as best you can to cut as many of the expenses that you can without really ruining the fundamentals of your business. So this is a really good time to take inventory and to make really, really tough decisions, and to maximize your ability to last, because at the end of the day, longevity and your ability to weather the storm is going to be really, really critical. And the longer that you're able to do that, the better your chances of coming out from the other side in a stronger position, because there's going to be a lot of movement out there. So this is a really, really great time to kind of look at your business. I think raising money is going to be a lot more difficult. So discussions with any potential investors to find out where they are, to get that landscape for startup companies, for companies that are pre-revenue, for example, and other kind of strategic decisions have to be made. I have a company that actually was not doing very well prior to this, but is in the space that could take full advantage of this pandemic. And they're actually starting to do the opposite, because they're starting to get a lot more business prospects as a result of this. So there's two sides of the equation, and this is probably the best time for you to really be honest and maybe engage with your financial advisor and do a really, really good deep dive on your forecast.
Yeah, I would reiterate that. It kind of starts with taking a really hard look at your forecast now. I mean, that should be almost mandatory. The first thing you do is, you had a plan before this, it's out the door, and it's hard to make those tough decisions without really taking a hard look at, okay, what's changed in my world, right? What are my new assumptions now? Because kind of the last thing you want to do is just run off and start cutting expenses without realizing where they're impacting your business, right? So it does take some reflection and some, looking at your forecast with a brand new perspective in today's environment.
One of the questions that came up was where people are reducing staff, IT, sales, support, and as people address this, are you seeing anything that can help? And Steve, it's to your point of just, you need to reevaluate your entire model, your entire assumptions, and figure out where you can make reductions.
And I think the answer to that question, Dan, really is unique to each company. I mean, each company has to determine who their critical people are and who needs to be retained to support existing clients and who's a little bit more expendable at this particular time.
Yep, makes sense. We have some questions about fundraising, and Alaa talked about fundraising. So maybe the question was specifically around crowdfunding now, and trying to gauge the market as to whether people are just in such financial hardship that crowdfunding is a bad idea, or if they're in a charitable mood and it's a good idea. But maybe you guys can talk a little bit about in this cash management challenge that everyone's facing, how do they figure in things like fundraising and crowdfunding?
I think overall, fundraising just became extremely difficult and more difficult than it normally is, right? And so that's why I think we talk so much about capital preservation. And but there is still, for any opportunity, there's still funds out there. So I'm not going to say give up, but know that you're walking up a much steeper hill. From the standpoint of crowdfunding, I'm going to say this: it's not extremely positive, but it's really my opinion, and my opinion only. Well, others might share it, but crowdfunding is a really good way to build an enthusiastic base for a product. It also is really ripe with liabilities across the board. In fact, one of the D&O or director and officer insurance brokers that I work with won't insure businesses that have done crowd-based fundraising in the past, just because they've seen too much liability from it. So for the near term, I mean, do what you're going to need to do to survive. But keep in mind that these ideas, they do have longer term implications that could impact you if you survive the crisis.
Dan, can I just offer a few points on this?
Absolutely.
So I still get many emails and from people in the investment community because of the investment banking work that I did. And I just got one this morning from the Family Office Organization, which is a national organization. And they actually have a video out, which is available to anyone who goes onto their website, and how to raise capital in this, in the COVID-19 environment. Keep in mind that investors still have jobs also. Funds, private equity funds still have jobs. Family office managers still have jobs. They still need to manage the investments they are in today and put existing money to work if it's sitting around idle. So I don't think the market's dried up completely. I think that it's maybe a little bit more selective, but I wouldn't discount it at all. Again, remember, investment people still have jobs to do, and they want to keep their jobs. So don't be afraid to continue a fundraising effort. What you might want to do is change your target market a little bit. So for example, where you were going with financial investors, outside financial investors, it might now be better to look at a strategic investor, somebody who can benefit from owning your business, an add-on to an existing business that's looking to invest in something that can enhance a company they are currently invested in. And then you might want to look at, I guess, smaller VC funds, angel funds. I mean, they're still, a lot of them still have capital to put to work.
Great. So we've got 2 minutes left. And so what I want to do is, one, thank all of you. But I want to give you each, 30 seconds, a minute or so. If you've got kind of one thing to say, we've got an audience that I know is stressed. They're trying to figure out what to do. They're taking a lot of deep breaths and trying to face this. So with all the things that we talked about today, if there was one thing that you want to leave for each of them, we'll go around the table really quickly here. So Steve, I'll go to you first.
Yeah, there's several things, but I will say that this whole situation is pretty overwhelming right now. I mean, we've been obviously all impacted by it. There are ways to get benefits, like what we talked about today, with the different SBA loans and benefits that are out there. There was a lot last week. A lot of my clients were anxious. I got to get my app in because they're going to run out of money. My perspective on that right now is, I don't think it's going to be like that. I think if some of these programs run out of money, they're more than likely going to be re-upped again. So I think it's better to understand it and get it right and not worry about, I got to get an app in today. I guess that's one thing that I would leave you with.
Yeah, you're starting with us old people. I don't know why, but we have more wisdom. Number one is kind of look at, I always kind of go back to humanity type thing, and don't overstress yourself. Be thankful that you're healthy, and kind of take care of yourself and the people that you love. So that's just the foundation. The other part is don't panic and make good business decisions. You know, I have clients that are not applying, for example, for the EIDL loan, where they could get a lot more liquidity because of the non-forgiveness portion of the loan, and going for the PPP option because of the forgiveness, where there's a lot less liquidity and does not extend the runway significantly. You know, those are kind of common sense business decisions. And I think in times of stress, making good decisions and being calm, cool, and collected is probably going to pay the most dividends down the line, regardless of how this thing turns out.
Great advice. Carl.
Yeah, hey guys, you get this. There's in history, there's always been challenges. You're going to have to make tough decisions. But as the other panelists have said, you know, think hard about the decisions, have your planning done well, and just most importantly, well, there's a lot of important things, but I think most importantly, pick good partners. Get people who are knowledgeable around you, who are going to help you through this, who are not just you know, play by night. Just pick right partners, make good decisions. You're going to have hard decisions, but when you get through this, man, the world is going to be your oyster. I have no doubt in the world that this thing, when it pops back, it's going to pop back, and those who've made it through this are going to reap the benefits. So you just be tough.
Rhonda.
I'm going to go a little off tangent here, but I'm going to suggest that you communicate with your team. Don't be afraid to communicate with your staff and let them know what's going on, and let them know what you are trying to do to keep them employed and the company in business until this is all over. I think you'll find that at the end of 8 weeks or 3 months or 6 months, whatever it is, that will be beneficial to all companies.
That's a wonderful way to wrap up today. I know from my perspective, we've got a great roundtable of financial minds, but the reason I love working with you is because you're great people, and we're going through stressful times, and it's great being around great people. So thank you all today for sharing your advice, your wisdom, your humanity. To everyone that was in the group, hang in there, keep going, and we'll get through this. Thanks again, everyone. If you need help from early growth, come visit our website. We'll follow up with this video that will be available for you in the future. But for today, we're signing off. Thanks, and have a great day.
Thank you, guys.